Digitalisation and urbanizations have profound impact on our cities and infrastructure, particularly for the demand, generation, and transmission of energy. This panel would discuss the outlook of this sector and how investment in it could shape a more sustainable future. Let us give a warm welcome to our moderator, Shen from HSG, and joining him on stage, we are delighted to have Coulter from TPG, Bruce Flatt from Brookfield, and Shemara Wikramanayake from Macquarie. Neo, thank you. Over to you.
Well, thank you. I'm glad, very glad to be here, and this is my fourth year attending the event. Congratulations to Eddie and the HKMN team to putting together another amazing event. I think today's topic for this session is about new energy, but broader base infrastructure. So we have a great panelist here. I don't think we need any introduction. Jim, Bruce, and Shemara, I think has been actually recently hit some headline news with their respective investment in this segment. So let's start from AI, because many of those demand for energy and for new energy are actually driving because of the AI. I think tremendous of increase of capacity. So I'll start by asking Bruce. I noticed that you actually were speaking about AI data center just about last week. Yes, you were saying that we can't build enough data centers. So what's enough for you? Your research paper published recently was calling for a 75 gigawatt of AI data centers for the global. And that means 7 trillion investment. That's a lot. So, sort of what's enough for you, and do we have enough demand for that? Because we heard a lot of comments in the early panel about, oh, there is this bubbleness in the AI investment journal, in journals. What's take on that?
Thanks, Neil. Thanks, Eddie, Howard, Sampson, for having me. I'd start off by just saying I think the perspective has to get changed a little. Before we built railroads, highways, all the infrastructure, water systems of the world. And what countries and companies are now doing is laying the backbone of the advanced digital economy that's coming. And when you put that into perspective, what needs to get laid down is that layer of infrastructure across the world to be able to drive business over the next 5, 10, 15, 20 years. And I think that's really what you need to put in the back of your mind. We're just laying the backbone of infrastructure, and all we've ever done in our business is just build backbone infrastructure around the world, and this is just the next layer of infrastructure. And what's really important to recognize is that it's very difficult to do what's going on. And the easy sites for data centers have been used up. Like literally every site 3 years ago that we had entitled was 100% contracted. And now it's hard work to find the next ones. And the good news, though, and this is where there isn't a bubble, because every single one of those is contracted for 25 years with the best counterparties in the world, and those today are either sovereign credit, so we're leasing it to countries, or they're hyperscalers with trillion-dollar-plus market capitalizations. And that's what's different. When fiber was laid down and everyone said we had Global Crossing going to go bankrupt, and it did, there was nobody leasing the fiber. What's different today is these are virtually all let on 25-year contracts. So I think we've got a long, long runway to go in this, and the inhibitor is power and execution capabilities. So it's not capital.
So you're basically alluding to that the hyperscaler has such strong financial power, and they have cash flow able to support it. And that's something you are betting on.
Yeah, these are 100% let often to very well endowed organizations which are driving enormous profitability within their businesses today, not from artificial intelligence, that hasn't come yet, but they're investing today.
Legacy cash flow.
They're spending $500 billion a year, let's say for the next 5 or 7 years. That's $2.5 trillion. In the context of their businesses, it's not that much. And what that is laying the foundation to be able to deliver enormous profits a decade, 15 years from now. And if this all works out, these are going to be $10 trillion companies.
Looks like a good math. All right, Shemara, so while Bruce was talking about not enough, you are also selling those data centers. You had actually some wonderful exit, right? I mean, last year you sold AirTrunk for $24 billion. This year you just sold another major data center for $40 billion. I'm pretty sure you have your LPs or your investors must be very happy about that. Are you also put the money back to that space? I mean, and tell us how you look at that space back many years ago when you building those data centers.
Yeah, and look, Ben Way, our head of asset management, is here with me, and we've had a few people asking us whether we've been calling a bell at the top in terms of data centres by exiting a portfolio here in Asia for $24 billion, as you said, last year, and then one in the US for $40 billion. But what I would say, I mean, there's been some really interesting perspectives given by people here both ways in terms of the growing demand, but then also the challenges with increasing technology with compute capacity and things, and will the demand be there, and the small group of off-takers there are. But I would say basically these exits reflect more the fact of the role we play in asset management, which is we start at the early stage and take things from about the zeros to the 20s, and then there is other capital that is well positioned for the 20 to 80 phase and other for the more stable 80 to 100. And so, when we invested in AirTrunk, we took it from 450 megawatts to about a 1.8 gigawatt portfolio, 11 sites. We took it from Australia and Hong Kong into Japan, into Singapore, into Malaysia, and then we exited at a point where the capital required to keep that journey going was beyond the scope of our funds. And the same with Aligned, which we exited in the US. I think when we invested that one, I think we had AirTrunk for about 3 or 4 years. Aligned we were in for 7 years. And we saw opportunity there to start very early with 7 megawatts. We grew it to 1.6 gigawatts of contracted offtake when we exited it. So we're selling a portfolio that it went from 7 million of EBITDA to 1.6 billion of EBITDA. So the people who came in are holding a more mature asset, but still scope for growth. So I think it's the role we play, and in private markets, there are many of us that play different roles. There are much larger funds that hold it through the next phase. The other thing I would say is here in the Asia region, there are questions about the US particularly, but in Asia, we did 1.8 gigawatts. We have 5 gigawatts here, and it's pretty clear the estimates are we're going to need 15 gigawatts in the coming years. But, there's fast-growing population. There's also the demographics of the urbanisation. There's digital adoption. So we think here there is scope to do a lot more. We still have 5 data centre portfolios left. So even though, yes, we did start 7 years ago in this area, we've got a couple still in the US, smaller ones we're developing. We've got one in UK, Europe. But here in Asia, Joe Bay was saying earlier that China is a big opportunity. We have a portfolio in China. We have one in Korea for North Asia. So we still see scope to invest in the area. And the last thing I'd say is this digital infrastructure for what's coming is not just data centres. There's all the fibre optic networks needed for it. There's towers, there's subsea cables. So our portfolio comprises those sorts of assets as well to support this transition that's happening. And particularly, I think, those of us here are focused on the Asia region for these sessions. And we have 50 portfolio companies in the Asia region. We think there's a lot of scope here, particularly with lower risk to keep investing.
Great. And Jim, I know you're also building massive data centers, but I want to ask you a different question. I mean, we all talk about massive capital, but what about human capital? What are the technologies going to make a difference in building those data infrastructures?
So I'm an investor, and it's always critical to get the questions right. And that question is interesting to me because no one's been asking it. So let's think about the questions we've been asking. Is it going to be big? I think we'd all raise hands. This is going to be big. Is there enough money around to do it? I was riding up the HKMA elevator, and the little TV screen said, you know, investors clamoring to get an AI. I'm not worried about money. You're right, Bruce. They've got $40 billion or $20 billion market cap. They can borrow $2 billion to do data centers if they need to do it. And is there going to be a bubble? We've asked that 5 times. Of course there's going to be a bubble. There is in every the idea that the market would totally land this perfectly is of course wrong. But here are the questions that are much on my mind. The sheer physicality of this, as you're talking about. So the biggest thing in real estate right now is Jamie Dimon's new headquarters. $3 billion in New York, it's taken 10 years, articles everywhere. I'm sure you guys are doing the same thing. We have one project in Texas that is $40 billion that we're spending in the next 3 years. No one's written a single article about it. How is that going to happen? Or if you go to the high level, the 10 biggest energy companies in the world outside of Aramco are $2 trillion. Data center spending over the next 3 years is going to be $2 trillion. If data is the new oil, we've got to remake the entire energy business in the next 3, like, how is that going to happen? And the question, I don't have a good answer, but if you ask that question, if you figure out how that's going to happen, there is massive opportunity. The second question behind that, though, that no one's asking is, like, who's going to do this? All of you are looking for AI advisors. I moved in high school. The first people who want to be your friends are not the people you want to be friends with. If they are advising you and they're really good, they should be in San Francisco, because I can tell you that's where it's happening. There's $200 million pay package if you really understand. Likewise, you guys know there isn't the human capital to build a lot of these data centers. The old data centers are real estate plays. They were just hook it into the energy, hook it into the trunk. Like, these are total, we're building massive energy malls. There's only a few people around the world that these large hyperscalers are going to trust to do it. And then, are you even thinking about it right? We tend to think by asset class. To understand what's going on, you've got to have technology, you got to have chips, you got to have services, you got to have a supply chain. So this is a massively complicated set of questions. And we keep asking the same question over and over again, where the benefit is going to be in these questions that were maybe not even asked. So if you go away from this, I hope you'll actually take some questions home with you, because I certainly don't know the answer, but one of the great techniques in investing is to buy complexity and sell simplicity. So if we can buy the complexity of this market and figure out the simple answers, that's the key.
Great, and we all knew that energy is a key bottleneck of that AI ramp up, right? So Jim, when TPG Rise gets set up, you talk about green transitions, new energy investment, but clearly with the tremendous growth of AI demand, you're not just looking at new energy anymore, right? So we heard some new buzzword, nuclear, which was not the case back 2 years ago when we talk about solar and wind. So what are the pockets of opportunity in the new energy space that you are most excited about, or broader-based energy?
All three of us will have a lot to say about this, but there's been, you need to first of all start with a totally different mindset than we all had a few years ago. So let me just go through the mindset shift that is happening. First of all, we were talking about energy transition. The key now is electricity addition. Energy and electricity are not exactly the same thing. As you guys know, in an energy transition, heat is important. Electricity has different attributes and has different winners in that. Second thing is, we were all focused on policy up through August, like what would they do with grandfathering? This is no longer about policy. This is totally about practicality. And it is no longer a religious debate over whether it's fossil fuels or not fossil fuels. It's essentially all of the above. So, you guys have a great deal going in nuclear. So it's nuclear, it's everything, because we are short electricity in the world for the first time. In the US, we haven't been short in a long, long time. And so the entire mindset has changed. And we now are going to see, just back to my sizing of this, the three biggest electricity companies in the world have a combined market cap of 200 million, and we're going to spend 200 million on the electricity market each year for the next 5 years in the US. Like, I have no idea how this is going to happen, but it's going to be interesting.
Great. So Bruce, back 2017, you bought a company called Westinghouse, which just came out of bankruptcy. Today, it's a company was just announced last week, is entering into a $80 billion contract with US government, right? You're gonna build a massive nuclear reactors around the world. Tell us about that investment, how that fits into your overall energy portfolios.
So we have been for 30 years one of the biggest builders of power plants. We started in hydro, we went to wind, we went to solar, and in 2017, we saw an opportunity to buy a nuclear company at a value which was how much you paid? Which was a value-based purchase. We put $1 billion of equity up, and we thought if nothing changed in the world, we'd do okay, and if odds favored that clean energy with nuclear was eventually going to come back, we just needed time. And I don't think we could have expected what happened over the last 5 years. As you know, and maybe just to step back on Jim's comments, is almost every single country of the world, but in particular in the United States, which is the largest consumer of energy, the grids are going to need to double over the next 15 to 20 years. The grids are going to double over the next 15 to 20 years. They've been flat for 25 years. That's what's going on. So the US government just gave us an order to buy upwards of $100 billion, but $80 billion to start off. It might be double that of nuclear plants. And the reason they did that is because they recognize that we need to restart the supply chain for nuclear in the United States to be able to build. And we were going to build one plant on our own, finish one in the United States, but we needed 10 to be able to build the whole supply chain out in the United States. So they committed to buy these nuclear reactors in the United States. They're going to give us locations for them on federal lands. And it's going to be really exciting for the sector. But maybe to the point, there's over 1 million gigawatts of power in the United States. And this is 20.
Nuclear.
Yeah, of total energy consumed for electricity, this is 20. What the point being, we need all of the amounts of energy of what's going on because of electrification of industry, of cars, and of data centers consuming enormous amounts, and so it's a very significant thing that's going on in the U.S.
Just to size this, and I'll jump off a second. Why do you get excited as an investor? The market for energy addition has been about 29 terawatt hours a year in the US for the last 15 years. It needs to be 400 terawatt hours for the next 5 years. So we have a market that needs to increase 10 times, and we have high payers coming into it who are willing to pay 2 to 3 times market to get power faster. Again, I have no idea how this works out, but this is a really interesting set of questions.
Great. So Shemara, you also put a lot of money into work in the new energy space, right? You just raised a new fund, actually, for that. Tell us, your sort of investment strategy in this new energy in connection with the AI, increased demand.
Yeah, and I think as Bruce said, it's not just AI, and Jim said it as well, everything is electrifying now. So together with population growth, urbanisation, all of that, these new trends of electrification of transport, everything is driving very big demand. And I think, sadly, we're dealing now, I know previously we had a sustainability climate focus on this, but we realise now we have to thread the needle between availability, the accessibility, and also the affordability of energy sources together with dealing with the climate impacts of it. And that is a difficult needle to thread, but it's going to need massive investment, not just in generation, which is what we've been talking about, but we need a lot of investment in midstream infrastructure as well. Grid capacity is constrained in just about every market we're in, transmission, distribution, also pipeline networks. So I think it is a big area that's going to need investment. The regulatory frameworks play a role in a bunch of this investment, especially bringing on new technology where they have to catalyse private sector investment through some support, but then also the planning approvals, etc. So having a good glide path for each country is important. So I think we work also with the public sector in most of the regions we're operating in to try and think about that glide path and what role our private capital can play, but we're going to need a huge amount of capital, expertise, etc. to deliver this.
Thank you. So let's go back to the legacy infrastructure investment, Bruce. So you also invest heavily into commercial real estate globally. What is the dynamics there? Do we see that market coming back as people back to work? What's your take?
So real estate in general, it's a cyclical business. One should always remember that. And there were two things that happened this time versus others. Interest rates went up quickly, and their mindset changed that people were not going to go and be in places. I think those are the two fundamental things. Each cycle is different, and this time it was those two. On the opposite side, fundamentals of most real estate in the world, Hong Kong a little different because the leases are short, but in most other places of the world, fundamentals are really strong. So you have underlying fundamentals are strong. What happened was the psyche of lenders and buyers got messed up, and interest rates went up quickly, and that affected financing. What's happened now is that interest rates are coming down. Everyone understands. Everyone's going back to the office. And all other forms of real estate are in excellent shape. What you've seen now is in most cities in the world, there is no construction going on, and there is no space left, and rents are going up.
Short of supply.
Rents have doubled in New York in good buildings, and they're going higher probably by another 50%.
What about Hong Kong? You're here, so what's your outlook for Hong Kong?
Yeah, so Hong Kong, here's what I'd say. There are greater experts in this room on Hong Kong real estate, but I'll make one broad observation. This is in all value investing in real assets, but in particular in real estate. If you have businesses or cities that are great places, Hong Kong qualifies. And if you have a tough market where things are down, they come back fast. And Hong Kong's turned, and there's very little construction. It's a very constrained place, and real estate values here will come back and be at their peaks at some time in the future.
Great. I hope that future is very close. All right. So
I wasn't talking about your apartment.
Okay. So one last question for Shemara and for Jim, right? So we talk about data center, energy. It seems to be that we're assuming there's unlimited capitals available out there, right? But in reality, who's going to fund those big investments? We knew that institutional investor has always played a very important role, including the sovereign wealth funds. But is retail have to be part of that picture, and how we look at that sort of, the supply side of the capital?
Okay, sure, I'll go first. So look, basically there are hundreds of trillions of pools of savings in individuals, in institutions, in governments out there in the world, and I think what we do as asset managers is we connect those savings with investment opportunity where we have expertise to deliver superior risk for the return. What we've been seeing is that pools of saving moving much more from markets like equities and fixed income into private market type assets, the less liquid assets. And that is happening initially through the institutional channel, but now through the retail channel. There are growing mechanisms, intermediated wealth, or now we talked about the 401ks in the US, to allow retail to access this. Also, insurance is looking to allocate more to these higher higher return potentially, but more illiquid and maybe more complex risk assets. So I think what we do is act as intermediaries where we each have our expertise to bring those pools of capital to investments through unlisted markets, listed markets. I mean, Bruce, you have a structure with listed entities at the top using listed markets. A lot of people use unlisted. We're moving more into insurance and wealth. And I think basically, the allocation overall is shifting where people are getting more comfortable taking the risks. Now, we do have to think about the illiquidity risk, particularly as we do this with unsophisticated investors and make sure they're looked after as they go into this. But I think we are seeing more allocation to private markets. I'll let Jim have the last word.
Jim?
Watch the private markets here. If you remember the 2000 tech bubble, we were actually right that the internet was big, but too much money was trying to go into it. 20 pounds of money was trying to go in a 5-pound sack. Same thing might be happening in the public markets now. But while that public market bubble happened in 2000, over in the private markets, we were creating Amazon, Google, later Facebook. So the business models are what to focus on here. Who has the best business model? If there's a good business model, capital is not the thing I worry about.
Great. So we're running out of time, and let's put our hands together and give this 3 panelists a round of applause. Thank you.
Thank you very much, speakers. Please remain on stage for a quick photo.